Once again, a very warm welcome to the latest installment of our ADDX Fireside Chat series. Today, I'm very, very happy to have Victor Jung from Partners Group to grace the stage with me today. And once again, Victor Jung from Partners Group is here with us to share a little bit more about democratization of private markets. Before I hand the stage over to Victor, some housekeeping. We do have a Q&A session after Victor's presentation. To ask your questions, please just type in your questions into the Q&A segment on your Zoom screen. It's represented by two speech bubbles. And if you don't see it, just mouse over to the bottom of your Zoom screen and the Q&A button shall display. I will pose then your questions to Victor at the end of this session to round off our webinar Fireside Chat today. Okay, now without further ado, because there's so much content to share in this space, I would like to hand this time over to Victor. Victor, please.
Thank you, ladies and gentlemen, audience. It's great to be here today, and thank you to ADDX and Darius for hosting Partners Group and myself here for this very interesting topic on the democratization of private markets. So I've been thinking a bit on how to make this topic a bit more tangible to the audience. First, let me start with a reading that I had that kind of shocked me last week. So you see Philip Morris, who is a tobacco company. They're known to sell the Marlboros and the likes. They made an acquisition to acquire a company called Vectura. And what this company does is a pharma healthcare company. It's a company that cures asthma through inhalers. So it's really a healthcare company. But now you see that cigarettes cause also a lot of asthma. It's not good. And the company that is just producing those tobaccos, they have to go with a catchphrase of beyond nicotine and change their entire raison d'etre. And they have a mandate to achieve $1 billion of revenue by 2025. So a tobacco company that is acquiring a healthcare company, how ironic is that? So this is the way that I see the current financial markets in the context of today's topic. You could be the disruptor today, but you could be disrupted the next day. And this is how I would like to start today's session, because this is where how fragile and how fastly moving environment we're faced in today in private equity, but also in the broader context of the financial industry. So let's put everything under the context of public equities before we do the dive in on private markets. Private markets exist because whatever is not public, it's private. Now, let's look at a topic that we're all very familiar with. These are stocks. Everybody does stocks, right? This is how friends and retails they also they do their own investments. But now let's look at what happened in 1996 versus what's happening today. I call it the state of affairs of the stock market. So you have more than 7,000 companies listed in the stock exchange back in the 1990s. Today, you see half of that, 3,500, give or take. Now you have to think, hey, why are companies not going public anymore? And the answer is very simple. Companies don't want to go public because it's a headache. Why? You have shareholders, you have the board, and you have management. So how do you satisfy all of those three? Management, they need to satisfy short-term profits on the quarterly earnings. The board, they're controlling management's expenses. So like even if your business is good, hey, you have too many things to disclose. Maybe your energy is not channeled. And shareholders sometimes they may want to short and sell your stock within 20 days, within a month because they made a profit. So how do you create value in 30 days in a company? You're actually destructing value. I mean, you have even research reports saying that hedge funds don't stay over 150 days in a single stock, right? And you have to see, hey, then now it makes sense. Public companies or private companies that before it was cool just to go public are staying private because it's just simpler, it's more efficient, they're focused, and they make more money. So I think this is the only way to explain, and this will give the background to private equity. These companies are staying private. This is why you see a lot of private equity companies teaming up with entrepreneurs, and they're giving them a life of 4 to 5 years just to focus. And where the board, the shareholders, and management, they're breathing and they're going to the same direction. And this, at the end of the day, is what produces the extra returns on the private equity side of things. So with this, I would like to start officially today's session. So what is private equity, right? You have to know that first, before we start, the reason why we're calling this democratization is because retail, mom and pops, they can access stocks, right? So a company, if they don't want to go public, they stay private. Can retail investors invest in private? No, they can't, right? So this is where all of the intent of this session is kicking in. And in order for that, I think it would be good to explain a little bit of what is private equity. So many people think, oh, private equity is vulture. It's hit and run. Actually, private equity is nothing different to the companies in the public side. It's just that they're not listed. So if you look at the left-hand side, public companies, the McDonald's, the Adidas, the Nestle, Apple. If you look at on the right-hand side, you also see very good companies that are private. Maybe they're public today, but at some point they were private. Campbell Soup, we all know in Singapore, Madame Tussauds, for example, Dr. Martens, they were all private companies. So it's the same thing, good companies. The only difference is, hey, one you can trade, and the other one you can't. They're owned by private equity companies. Now, let me put it into context. Private equity for everybody is nothing new. It's on a day-to-day, it's on our daily life. So let me put my life into one day and see how close I am linked to private equity. And this will be also the same for all of the audience here. So let's say I wake up at 6:30. First thing I do is I'm aging, so I need my vitamins. So I take it from GNC, and then take a shower, and then I get my Bausch & Lomb contact lenses. Let's say I'm heading to the airport, I need to pack. My bag is a Delsey bag. We all know what the Delsey bags, they're also a competitor to Samsonite. So I pack my bag, and then I go to the airport. Let's say I'm in Switzerland, I go to Swissport. This is the owner of Zurich Airport. And after that, I have a meeting. After I get down from the airport, I have a meeting at 5 p.m. and we're using a lot of books and materials, and chances are that these materials are published by the likes of the Springer or Avaya, which are publishing companies that are also held privately. After I'm done with the job, I go shopping to keep my wife happy. I go to the department store, and of course, I'll buy her Hunter boots. Again, a private equity-owned company. After that, hey, I've done my shopping, I've done my job, let's go for drinks. I'll go to the pub and buy a beer, let's say a Hogarten, which is distributed by Starbev. Again, another example. So every hour of the day, we are all exposed to private equity. And it's nothing different. It's just a matter of education and really understanding that these are no different to companies that are listed. So let me touch base a little bit on the history of it. Why, if this is so good, where are we today? How does this developed? So private equity is a concept actually that was born in the US. I mean, companies have always been there, right? I mean, you can trace the public stock markets as early as the 1700s. It's London, it's New York. But private equity, the institutionalization, the perception of the market itself, it happened with the first transaction in the history books that called the first private equity transaction ever. This is when JP Morgan, not the company, but the individual himself, bought the Carnegie Steels from Andrew Carnegie. So that was the birth of what you call the first transaction of private equity. Now, fast forward, after that 1991 transaction, what has happened? yes, you see a lot of families and angel investors sitting here and there, but this has become a bit more institutionalized by the Small Business Act in 1958. This is an act that was signed by President Eisenhower, in where the bank would allow so-called fund managers to get leverage from the banks to do their own acquisitions privately. There are some hiccups here and there. Pensions were not at the beginning allowed to invest in private equity, but in 1980, Congress passed a bill to ease the tax and the participation to private equity, and hence you see the birth of Blackstone, for example. I think it's 1985, Carlyle 1987, TPG 1992. All of this, the big scale private equity players give birth right after the evolution in the US. Hence, 1990s, this is where everything happens, US focused, but ever since, the market has been developing very fast. Now, late 1990s, you already see it's not only a US phenomenon, it's slowly transitioning into Europe. And then by early 2000s, you see also the penetration hitting Asia, but it's not only about private equity, it's also about infrastructure, it's also about real estate. So before even real estate infrastructure was classified under private equity, which is just private. Now, as time passes by, hey, we all find out that there's a need to further isolate different asset classes because of the different risk return spectrums. So where are we today? Private markets, which comprises of private equity, infrastructure, and real estate, AUM-wise, we're sitting on a $7 trillion US. Still a fraction of what it is the public's, but still is today we are at the epitome. It will still grow. I mean, we have a lot of research reports that say, hey, 13 trillion by 2025. And the reason is because it's an asset class that is not correlated and because it performs better. So how does private equity, make and achieve those returns? So a stock, you can get lucky one day and tomorrow you can sell it at 3x, right? But how many stocks do you have like that? Those are very, very dangerous. We see private equity play as something very pure in where you live with management and you observe and help and you have a relationship, a very personal one for 4 years. Top line, bottom line, and you draw a long-term strategy and you just start executing and focusing, and they don't have to focus about the short-term expense. I mean, you invest and incubate so the business can become from, let's say, a local player to a regional champion to an international champion. And there are a lot of companies that have this potential, but just they have not been discovered. So private equity is all about focus, long-term, and really doing the work, rolling up your sleeves, and really making that company a champion. And then value you set at the right level, and this is how the returns are achieved. Of course, the advantages are that you're focused. The board, the shareholder, and management, they're all breathing together and thinking alike. However, and perhaps this is the reason why retail, so even in this aspect, retail would also belong to a high net worth individuals to a certain extent. Private equity is illiquid. You cannot trade private equity, unlisted companies. There's no liquidity. And typically, for an individual to invest in a private equity fund, you have a minimum threshold of 10 million, which not everybody has 10 million to invest. Hence, it becomes a barrier to access the private equity industry. Last but not least, things such as capital calls are something that the day-to-day investor is not too familiar with. So this still makes the private equity industry an institutional industry with very little participation for the non-institutional space. Now, there's a consensus today, and this is why the democratization is happening. Now, everybody is finding out that, hey, private equity returns there's an alpha, there's a higher return that you can achieve in private equity. And heck, I want to invest. So if I have to do my retirement and I need to earn my money on the 3,500 stocks available in the US, like, that's why Dogecoin is happening. That's why GameStop is happening. Like, you cannot explain the sentiment behind companies that cannot go digitize and get, like GameStop is not a company that, for example, can be digitized, the business model itself. So there has to be more room for the day-to-day retail investors to participate in private equity. Now, there's a consensus in the market that this should be an asset class for the retail investors to invest. I mean, you can go through any publisher or research reports. It's a fact due to the long-term value creation nature of private equity. The returns are higher than what you can achieve on the listed side of things. Hence, you see now a huge wave of democratization from the ultra high net worth, the high net worth and mass affluent trying to access the space. And what's really catalyzing that movement, I believe, is the tech side of things. So, funny enough, Singapore is an Asian hub. You have from Chinese, Japanese, Koreans, everybody's here. And one thing that I thought was very interesting was the word democracy that you see. This is a Chinese character that is used simultaneously, not only from China, but also in Korea and in Japan. They all use the same minjuju, we call it in my language. It's the same word that refers to democracy. And I would like to start with this word because, private markets has not been democratized. It's an institutional play. And this, I would say, is the key word being fueled by tech, democratization of private markets. So it's important to see where we are today on private markets. It's in its path to democratization. If you look at the institutional investors, the green line, this is actually the holy grail for all asset managers. It has been an institutional market alone. I think since 8 years, you've seen more and more asset managers trying to cater to the wealth channel. So the likes of the UBS, Credit Suisse, they have huge pools of family offices and ultra high net worth. Altogether, they can be bigger than an institution. So you see wealth managers coming in and accessing private equity. It's been more and more visible since 5 years ago. But today, you see fintechs such as ADDX, and also fintechs, not only on the public side of things, but private markets focused fintechs like ADDX, who are trying to even further fractionalize and democratize access to private markets, not only to the institutional, but also to the mass affluent. And God knows, I believe that in the future, retail investors, my family, would be able to access private markets, because if you don't access, I think you're being excluded from the right to make retirement income in the future. So it's very important to acknowledge that this market, just like Philip Morris is facing, it's a market in where things are happening very, very fast and being disrupted by technology. Now, very important now again to explain what is the market today. So the global investor market says give or take 150 trillion total. Now, what people don't realize is only 84 trillion is institutional. If you look at the right-hand squares, you'll see that the mass affluent is actually 45% of the entire universe. 45%. So, hey, this is 68 trillion. And here, I may not be counting the real retail. This is mass affluent, high net worth, and ultra high net worth. What's shocking is this 45%, which is equal to 68 trillion, is poised to grow to 106 billion by 2025. Now, where does the story in the private market side kick in? Is, hey, look at on the right-hand side, the allocation of these retail investors to private markets. At the most, it's 5%, at the most. Whereas in the institutional side of things, you see the pension funds, in the US, for example, they've already reached 28% of allocation towards private markets. Endowments such as the Harvard, Brown, Yale, they have a 52% allocation to private markets. before we move, think about, hey, 5% at the most. If the individual investors, they have friendlier structures, I think that's what ADDX is also trying to achieve. If they have more access and opportunities for the retailers to invest in, and having 1% more of growth, this could be, a revolution in itself, in my opinion. So there are some, the most research reports, and there's one that we all should be looking at, is the Morgan Stanley report on the wealth management side of things that was released recently. State that if an individual investor on the wealth management side of things, they start putting a 5% allocation on the private market side. Now, I told you about 7 trillion, and this will go to 13 trillion by 2025. If the allocation grows 5%, there will be a minimum of 1.5 trillion worth of opportunities of AUM growing from the retail side of things. So today is less than 10%. This paper states that, hey, there's room to grow even up to 23%. Now, even on the regulatory side of things, wanting to do something is one thing, but hey, you also need the regulations to help. I was very shocked when I discovered this article. It's an old one back in 2018. I put it here just to make the story even more tangible. Everyone knows SEC, like the MBS. You have a regulator that states there are fewer investment opportunities for mainstream investors. So if you look at this quote, it states retail investors have less access to the market as a whole, and I fear less access to companies that are well established but still growing. So you can access before in 1997,000 companies plus. They are limited to 3,500, and most of them are FANGs, right? Hey, if you don't protect, if you don't give a chance to the retail investors to retire, make their retirement income, hey, this is not fair. So this is where the democratization element is kicking in. By the way, the SEC and the Department of Labor, we all know that they have been reinterpreting the accredited investor clause to apply to a broader audience. Hence, you see the 401k pension plan also being able to access slowly the private equity side of things. Now, if you look at this bar chart, hey, they see the retail demand for alternatives going forward. You see everything going down. The only two that are up is ETFs and alternatives. So this tells you that the trend of this market is poised only to grow, and private markets, it's only grow going forward. Now, there are 3 contributing components to this democratization. DIR. D stands for digitization, I, innovation from the fund managers, and last but not least, regulations. So digitization. So you will recognize some of these logos, including ADDX. So these are, tech-enabled platforms. Some of them do publics. Some of them are private markets only. Let's look at the figures in 2018, the amount of fintech startups. And now compare that to the official stats as of February 2021, 112% growth. I mean, the numbers will go even higher. Now, hey, you can argue fintech. So what is fintech? Insurtech, prop tech, payments, et cetera, et cetera. But we all know wealth tech takes minimum 19% of this fintech ecosystem. And a lot of these fintech companies that are doing wealth tech, hey, are also being founded every other day. And an example is all of the logos that you see are relationships that, for example, us as a firm, we are entertaining today. So it's not just a story; it's actually happening right now, and it's happening thanks to the tech side of things that are enabled by these platforms. Second contributing component is innovation. So hey, so we see demand, we see an opportunity, untapped investor base. So what do? We also structure products to cater this investor base. So I told you retail is not about the mom and pops, it's also ultra high net worth, high net worth. So everything that is non-institutional is considered as retail. For example, Partners Group signed a JV just on the private markets as UBS of 1.5 billion. This has never been done before, would have never catered before to just a private banking clientele, but it's happening. Second, you see on the bottom, in the middle, on the bottom quote, in Europe, there's something called LTIF. It's like UCITS. UCITS is for public funds. LTIF is something called European Long-Term Investment Funds. It's a government-led initiative to have more retail investors access private investments. So we are already in 2.0. The first funds in the LTIF regime, KKR, Partners Group, we were the first two to launch an LTIF series in Europe. And there are today more than 100 funds registered. And this is what we're getting at 2.0. So the market is also evolving from the fund management. So you see the digital side, you see the fund management side of things, and last but not least, the third element, regulations. Now, wow, the US, 401k market. This is the people's market, right? This is mom and pops retiring. This is a retiring market that has never been opened for private equity. Now you see movements of this market being opening to the private equity side of things. And this market alone, the 401k market alone, is a $6 trillion market. Now let's see, hey, these are components. What are we seeing? So Moonfair, we've heard from I laughed at the ad that they made at Financial Times on the first page. I saw this like 2 times per week. If you look at it, they say, put your bonus to work, right? So, you can see a lot of rich people that have their business, they don't have bonus because they don't need to. Only retail people, investors, they have bonus because we all have a job, right? So it's very smart how they're accessed. This is the true democratization. Hey, these tech companies are accessing, the daily employees, convincing them to put their bonus to private markets. These are some outdated figures, but already in February 2020, Moonfair has surpassed 250 million euro in assets under management. The latest stats are over 500. So the digital side of things is already happening very fast. On the fund management side of things, fund management Partners Group, hey, our AUM is already 27% on evergreen structures, which accommodate for retail investors on the high net worth channel. And when you look at Blackstone, they also claim, hey, the latest fundraisers, they had more than 15% of their funds being raised from the retail channel. So this is huge. The market is already moving very, very fast. Now, on the regulation side of things, and this is somewhat related, is I think the regulations are not in speed. The speed of the regulators is not catching up as fast as the change on the tech side of things. So you see a lot of weird things happening. I say, GameStop, Dogecoin, and even SPACs, right? And then you see more things that will happen where the regulators need to be, on top of things. And this is the fund, private equity funds being tokenized, like this David Sachs gentleman says, ex-CEO of PayPal. So this is, I believe that the democratization will be further achieved through the likes of tokens, also through the likes of SPACs. SPACs is also a way to democratize, because then, my mother could go to buy a share in the SPAC because it's listed, right? So it could be a private company that is a SPAC. So it's the democratization is happening through all fronts, from the tech side of things to the industry and to the regulatory side of things. Now, this is my last slide, and for me, if I were to pick, these 3 factors have to go in tandem, right? They have to go in concert. But I think once the industry marries technology, things will be exponential. Let's not forget one thing, right? Let's not forget that retail investors in the public markets were less than 5% in 1990. And today, direct holdings is 28% of the entire public market. And if you combine ETFs and indirect holdings, it's more than 58%. 20% of the daily tradings are retail in the stock market. So when you take that into consideration, hey, if this is making more money, retail investors will only come, it's a matter of time that will come to through tech, through private market. This is the hockey stick, I call it the hockey stick graph that you see. Is an example of Invesco teaming up with Ant Financial. And you see the hockey stick going up the moment they team up with Ant Financial, regardless of the stories that are happening today. This was back then when they signed the JV, their AUM quadrupled in months. How do you do that? It's because it's seamless, it's trackable, it's complex, so everything is digitized, it's scalable. And I believe that tech would really, exponentially speed up the democratization trend of retail to private markets. This concludes my presentation today.
Thank you very much, Victor. Lots to unpack there, and of course, ADDX being at the forefront of digital securities, we are very much in support of everything that Victor has shared with us today. So I will just enter into time of Q&A right now. I'm mindful that there are so many questions being posed by the audience, and I will attempt to answer as many of them as we have time for. So if I can just ask the team to let me know when we are just running out of time, and I'll wrap up this segment. But I hope to get through most, if not all, of these questions. But first, let me just start off with a very sort of practical question, right? So, for example, if you have like a a vanilla kind of what we call a retail investor that is active in the public markets, stocks, maybe some bonds, maybe some mutual funds and everything, what would you say to this person to convince them that he or she should add some private equity to his portfolio, or and how he should think about how much to add?
Good question. I mean, this is not only for the individual, but this is an argument that we always make. It's the same thing as how do you, I'm not saying you should do cryptos, but this is also the same as how do you convince somebody to add crypto in the portfolio. So I guess first thing is we've all heard this famous saying of don't put all of your eggs in one basket, right? Because if the basket breaks, then you're broke. We all need to make a living. We all need to feed families and also retire without working, because we've been working very hard. You need something that is uncorrelated. You need another basket, right? You need other eggs in this other basket. It doesn't need to be half, but it could be 10%, 5%, where the growth is uncorrelated. So even if it falls, your first basket falls, you still have enough money to, let's say, retire. And you can plan for the worst case scenario. And it's a long-term play. This is not something you have to activate. It's like buying a house, right? You can buy a house, you can buy a car. It's just a different asset class. You just have it, you wait. And if you are teaming up, and if the product is right, hey, it's a money multiplier private equity. 5, 10 years, it could be, if you're lucky, a 3x, a 2x, a 1.8x of the initial amount that you invested. So it's correlation, diversification, and returns.
Yeah. We have a couple of questions related to Partners Group here. So, of course, Victor will be very qualified to answer them. Can you tell us a little bit about, what is the track record of Partners Group, and do you specialize in different strategies like LBO, VC/growth, or whatever? And the broader question is this, right? There are so many PE funds or firms out there. How should one, if I want to go into the private equity or private investment space, how should I choose, right?
So first, and this is why we're also very bullish on ADDX, is if you're an institutional investor, you can choose everybody, you can meet everybody. But if you're retail investors, you don't have any options. The only option you have to access to private companies would be, stocks, or which is not proven, of course. I mean, 90% of them are traded below value. The only way to access them would be through the likes of ADDX, right? And this is why the term democratization is happening. You go to a private equity investor, you say, I'm going to invest $2 million. They're going to say, hey, sorry, we don't have time for you, because the regular private equity guys, they deal with very minimum by the legal docs. It has to be a 10 million. And some of them can be a 500 million, 1 billion single client. So, by the economics, that person cannot afford, spending time with that 2 million when he has to depend on the 500 million and the likes. What you should choose is actually a matter of taste. It's like, hey, on the public side, do you like healthcare? Do you like fintech? Do you like consumer? Same thing on the private equity space. You have a lot of different investors. First, private equity is everything from angel VC, private markets, I should say, angel VC, real estate infrastructure. And in private equity alone, you have sector experts, also tech experts, healthcare experts, consumer experts, and you have sector agnostic global or regional experts that go by let's say China healthcare only, or they go, Europe fund only. So it's a matter of a taste, and also you should definitely look at the track record available throughout the different financial crises or crises that that they may or may have not come through.
Okay. And will you be able to share a little bit about the track record of Partners Group, since you mentioned track record?
Yes, so all I can say is above benchmark, top quartile in what we do, but what we focus on, maybe a better story, is mid-cap to upper mid-cap companies. We do everything globally. So an example would be, hey, we would like to incubate a private company that is, the #1 company in Hong Kong, so to speak. And they have every right ingredient. They already own 20% market share. It's an OEM manufacturer. Let's say, hey, we invest, we back the management for 3-4 years, and they could grow. They could do a lot of M&As. We could do top line, bottom line growth. And 4 years after, this company from a Hong Kong regional champion could become the #1, monopolistic global champion company. Then these are the type of investment that we try to do. And reason being is they're more proprietary, non-auction companies. And this is a separate topic, but you need to be able to establish a relationship with the owner of that business in order to agree on the long-term growth and long-term plan. But how we do it is we try to access the non-auction private proprietary situations of market base in order to identify the right companies and grow them 3 to 4 years after an exit. And we do it globally.
Thanks, Victor. So with your presentation basically told us, and I do agree that private equity is a big and growing space, and there's so much interest in it. The flip side is this thing that we've been hearing on the street, right? That there's a lot of dry powder coming in. It's flooding the market with liquidity. The valuations are very rich, and so what's your view on that? Will it diminish forward returns, and specifically, how does Partners Group manage that?
So this is a very tough question, and I hope you don't. This, by the way, it's a personal opinion. It does not constitute for the opinion of the firm. But let's say the first that we always get asked by public experts is, hey, valuations. Now, why do we never talk about valuations of public companies that are sometimes 2, 3, 4 times more expensive than private companies, right? And people still invest. Why? Because there's a future. So to begin with, the valuations on the private equity side are still today cheaper, lower, I would say, than the public side of things. What it will be like going forward, no one knows. But that's why private equity is not a multiple game. It's not just the market sentiment. If a company just grows on their pure revenue and EBITDA side of things, there's no way that you can lose money on that. That's why, hey, a good company on the public side, there's nothing wrong with tomorrow. Something happens, and you'll be losing your money. But in private equity, you're not correlated to that because it's not a listed company, right? So the shareholders, right, who is the private equity fund and its pension fund, for example, they're backing with a long-term view. We're making the decisions together. We're saying, hey, don't worry about it. Just keep increasing, hire more people, file for more patents, more R&D, grow your revenue, your net income, your EBITDA margin, and then, hey, we exit. Then, there's an element of visibility and predictability that is associated with private companies. So yes, there may be companies in where fund managers just invest because the industry is good. What you have to differentiate is there are companies, private equity fund managers, that will have a majority stake, that will work together 3-4 years, and then really, help that company achieve that intrinsic value, that potential to where it should be. And then this is a fair game. Yeah.
Thanks. Returns, of course, the potential is there. Now, the flip side of that is risk, right? So from an investor's perspective, I'm building a portfolio, I'm adding private equity. What risks should I be aware of, and how should I manage them?
Yes. Again, a tough question. Risk is an investment, so we all have to be very well educated. You have to know what is an IRR, what is a money multiple. You have to be aware of your fees, right? And the reason why I'm saying this is private equity, it's equity. So it's like a stock. become a Bitcoin just to make it more tangible. I hope you don't just buy things just with a blind hope that it will go up tomorrow. You need to know what your risks are. You need to be able to identify your story or your view with the company's business. The risk here is if something goes bad, if there's a new technology coming in or competition kicks in, right? If the industry that they are in is not, there are no trademarks, there are no patents, right? They're not protected. That's your due diligence item. The competition will come in and they'll smoke them, and this company will not be able to grow the revenue, hence your equity may get wiped out. So you will lose, the company may not grow, your investments will suffer. The risk is that, hey, it's equity means that the returns are there's a risk of the equity being blown out. So you need to be familiar with the nature of what equity investments are, that hey, always disclaimers in advance, you can lose money. That's why due diligence is extremely important. Are you backing management? Are you backing this industry? Is this company strong enough to be anti-cyclical? That's why in our firm, for example, you have 2 layers of investment committees. You have a 200-page document for each investment that we do, and sometimes we analyze that company for over 4, 5, 6 months. So once you have this amount of time being invested into a company, and you do it, and it's very hard for this to go wrong. But even if you do it, things happen, right? And things go wrong. So yeah, that's the risk that you should be associated with.
Yes, no risk, no return.
Exactly.
Yes, correct. In terms of specifically IRR, right? How should one think about targets IRRs, right? For an actual average investor, and for Partners Group, what would be how your fund's IRR targets and sort of.
So and also it's a very good question. Let me put it more in the target IRR perspective. So I've mentioned that why private markets is more of a compelling story at this stage, because it offers an extra return that is not being offered on the fixed income side of things, on the stock side of things. Of course, you can get very lucky on a single stock and hit home run, but the broader the indices state that private equity has done better. It's not correlated. Private equity, due to the illiquid nature of the asset class, it's more of what I would call a money multiple play. So you have to be ready to face that illiquidity. And typically, what a normal private equity established manager would underwrite would be to be fair, a double-digit return, on the teens. But now you have vultures and other opportunistic. It depends on what kind of strategy they're pursuing. But a normal private equity fund should give you at least a very high single digit, but very minimum. It has to be. I mean, if you're good at what you do, you should be on the minimum IRR. But be aware of how the internal rate of returns are calculated, and there are 2 different things: IRR and money multiple, which is the TPPI. So you have to measure both things and see how much money you have made through that period of time.
You'd be able to explain a little bit about money multiple and PPI.
So this is and there's maybe the audience, they may not be able to fully understand it. And again, it's a good point that you mentioned that private equity players are coming to the market with non-capital called structures to make it look more like public mutual funds, right? So an IRR is a function of money in and money out. So what you have to know, and I know you have a hard time understanding this, is let's say you have $100 to invest. Private equity company will most likely charge you a fee on the $100, a management fee on the $100. Your called amount, because the fund, they don't draw down the entire $100 on day one. There's something called the investment period, which is typically 3 to 4 years. And your IRR is basically calculated not on the $100, but it's calculated on the money in and out, called and uncalled. So gradually, there's a time period of things that you need to cater in to calculate the IRR. So if an IRR is high on the short period of time, it doesn't say they're doing a fantastic job. But that doesn't mean that at the end of the day, they're still doing a fantastic job. I mean, there's a time in where the value creation is not meant that exiting the IRR will be on that time period will be different. That's why you need to look at so money multiple, 10 years from now, how much money has this fund manager, how rich have they made me? If it's a double-digit IRR and two times money multiplier, that's a great outcome. So you need to really look at two things: my money at the end of the day once you exit, and the IRR in that specific period of time. A bit of it's not straightforward at the beginning, but yeah, I've done my best to
Thank you.
It takes time.
Yes, that's fine. Yes, thank you very much. And of course, private equity, there's lots to understand. It's pretty different in terms of behavior, risk return from public markets. If I were a beginner investor into private markets, you mentioned that how I would select, let's say, funds or sectors, whatever is a matter of taste. But if I don't have any experience at all, what would your advice be on where to look, where to read, what resources should I start with first?
In order to access this,
to understand, to be able to choose.
Yeah, I think if you can afford, trading stocks, I think it's always good to, YouTube is a great tool to understand the basics of private equity for free. If you have time, of course, CFA is always a good way to really understand and become perfect. But I think the best way to understand is through the public channels, YouTube, or taking courses. I will always help you understand. You have CAIA for the alternative side of things, but also I put it on the weight of the platforms such as ADDX that should also, as a fiduciary duty, should be able to explain what are the things that one should watch out when doing private equity investments. But I mean, the fastest way is, of course, through the YouTube public channels, and also through being a member on the new platforms such as ADDX, or you see a lot of tech platforms these days that offer alternatives. They would always give you a minimum education session where you can understand better. But I think it's just, don't put it on the platform. It's more on the individual himself or herself to strive for higher education. It's all about money, right? I mean, if you want to make more money, you have to work on it, right? So it's the same thing. If you want to buy a condo and you want to know where the condo is going to rise in price, hey, you have to do your homework. Same thing with private equity. I think you have to read read the newspapers. I think that's the top newspapers. You always have articles about GIC, Temasek, MPS, KIC, Blackstone, BlackRock, KKR. Once you start, reading the papers at least for a year, you'll be exposed to the very minimum and general things about private equity.
Fantastic. I'd like to just bring up this point about long tenor of private equity, let's say funds or even investments, right? Public markets, of course, are tradable, they're liquid, and private markets are not. And by adding something illiquid to your portfolio, how should an individual investor think about that? It's such a long tenor kind of a part of the portfolio.
So it's very unfortunate to say, but today, if you're individual investors, you do not have the right to invest into a liquid fund. The legal documents does not allow, and the regulator does not allow us to raise money from the retail universe. So it doesn't exist. That's why things like SPACs are happening. There's one way to get exposed, but this is why this session is very important. This is what the platform ADDX, and this is why we are also very keen to further collaborate with ADDX. ADDX is actually trying to have efforts, initiate efforts to democratize access to private equity funds alongside our institutional clients by structuring with tokens, security tokens, access to private equity funds such as ourselves within the legal boundaries with the regulator.
Thanks. Yeah.
So long story short, sorry to say that's why we're talking about democratization, because it's not democratized for the non-institutional investors. I mean, best of luck if you are, if you have enough money and you can be by Singaporean standards an accredited investor, then you can talk to your private banker. That's the only way. Private banks do have, that's the first wave of democratization where the likes of UBS, even UOB, they have access, one or two funds always for private equity.
Okay, but if you're outside of the private banks,
you don't have any. You just don't have. The only ones that have access right now, the lowest tier has been the mass affluent. But under the mass affluent, you just don't have access. This is why this industry has to be further democratized.
I can't say I disagree with anything you just said. That discussion on IRR and multiples and all that has generated quite a buzz on the Q&A platform. Yeah. If I'm an individual investor, should I be more concerned about IRR or multiples or TVPI when let's say if I look at a fund?
Yeah. If you are somebody who is running a portfolio, right, and you want to track that amount at a certain period of time, right? I think it's important to look at the performance until up to that date. But the IRR sometimes does not tell you at the end of the lifetime how much money you've made, because again, the hard concept to explain is an IRR is calculated only on the money that has been called for your principal. So there's a time value of money that has been applied into. It's a mathematical equation. I don't know who came up with it, but it's the industry standard that the pension funds use to track it at that point in time. And if it's negative, maybe you're losing that money at that point in time, but hey, this could rebound 3 months from now, and at the end of the day, it could be rebounded again, and you could still be making 2 times money multiples. So as an individual investor, short term, I think IRR is a stronger representation, but you have to look at both, because you need to look at the time and the absolute money multiple at the end of the day.
Okay. And will you say that market benchmarking would be one sort of way of knowing whether
yes,
particular IRR?
Yes. Benchmarking is one, but again, benchmarking, you as an individual, I don't know if you have access to the institutional research benchmarks, but yeah, of course, benchmark is definitely a way too, but it's not apple to apple. It's like apple and lemons, because stocks, there's no capital call. You're fully in and out. Then IRR and money multiple, sometimes like they're the same zone, but on a private equity company, it really depends on the money that has been invested and called.
On this point, I just want to double click on this benchmarking thing, right? You mentioned, you spoke about Partners Group being top quartile and that sort of thing, right? So how important it is for an investor to pick a fund that's top quartile? I mean, I've heard of again, the word on the street is that variability in private equity returns is much more than public equity returns, right? And therefore, that top quartile performance is actually pretty key. So maybe you can share your thoughts.
So I think it's like, all of this insurance disclaimers, no one wants to read that because, it's like, fund size 3 and it's half of a page that no one will read to. But I do encourage, like Darius mentioned, benchmark is very important because, let me put it this way, it's like buying a, let's say the DBS stock versus buying a new bank stock that just got its license, right? 9 out of 10 people would buy that DBS stock. Why? Because it's big, it's credible, there's a brand, there's a reputation. Same thing in private equity. There are mostly 2 very strong benchmarks: is the Cambridge Associates and it's also the Preqin data that really piles up. One thing that you have to watch is, on the disclaimer, is it apple to apple, right? It's not fair for, let's say, a credit fund to be compared with a buyout fund, or you have to be, you have to put it apple to apple, and the disclaimers will always mention that. You have to compare whether this is a secondary or this is a fund of fund versus a direct buyout fund. So, Cambridge Associates, they do have their own benchmarks per category, and you need to make sure that all of those funds, you have to put it on apple. All of those funds within the category, they need to have gone through the same time period. So it can't be that one didn't go through the first financial crisis and went through COVID, and they did a back test and they claim that they're better. That doesn't work. A benchmark always works in a fair manner. These funds have to be at least minimum for 2 to 3 financial crises. So you pull them together, and then you will have the rankings on quartile basis per benchmark. So it's up to the investor to really do the comparable homework through those benchmarks by the channels such as Cambridge Associates and Preqin. But you will see that there's a pattern here. You always see the likes of Blackstone, TPG, because all of the top names, because these are, allow me to tell you, these companies have been only funded in the 80s. It's still a really new market. So these are, the earlier ones are the most established ones because they've been able to find the best way of doing things and to doing investments. So, you're safe when you buy a DBS stock, when you bank with the ones that you know, and the likelihoods for this to go wrong, it has to be really, you have to be unlucky for this to go wrong.
What I'm hearing is that a very long track record that's punctuated by
correct,
market dislocation, yes, and how that
exactly
performs.
So how you look at it is anti-cyclicality. So it's like, let's say we had a mezzanine investment with this company called Arnott's, which are very well known to produce the manufactured Tim Tam biscuits. One of the reasons why we decided to go with this company to invest was because if you look at the global financial crisis, most of the companies, the revenues dropped. This company grew by 3%. So, hey, we found out that people actually, when they get stressed, they eat sweets, they eat biscuits, right? And the Australian market, I mean, I don't know if you've had this, the Vegemite, Vegemite, people like butter, and, it's not something that people buy, but in Australia, this Tim Tam and the Arnott's brand the penetration rate is more than 90%. It's the two best brands together with burgeoning. So we thought, hey, this has been anti-cyclical, and even if COVID happens, people will still buy biscuits, and this company will be profitable. So you have to look at the anti-cyclicality, the different financial crises, and if the numbers are good, that means it's a reflection of what this will mean probably to your money.
Fascinating discussion. I'm aware that we have just crossed over the top of the hour. I would just like to squeeze in one last question before we drop this meeting, because I could go on all day. But
there's the question they were asking me. It's not like 3 hour. This requires 3 hour explanation. Very challenging questions to answer.
I do my best.
Okay, all right, I'll do my best. So I hope we can have more time to explain. But go ahead, shoot the last question.
Right. This is in terms of size, right? Yeah. When funds have different sizes. You have the boutiques, you have the giants in the industry like Partners Group and everything. How should one think about size in terms of whether it gives an advantage in private equity?
Again, I could put it in the context of taste. The more niche you are, sector driven. So you have something called the angel VC startup. You have small cap, you have mid cap, and you have large cap, right? Large cap, you see $1 million plus, the flagship funds. VC is much more like with the exception of the SoftBank, and they're the first one that came with $1 billion funds. But all of them are available. This entire spectrum is available. It's what is the story that you believe in? All of the managers, they have their own expertise. Now, you as an investor, even like the likes of GIC, Temasek, they don't do everything. They say, hey, right now I'm bullish on China tech. And they're bullish, then they do an all-in in that specific stuff, right? So don't go with the fund size. Of course, the bigger they are, that means it's fund series 3, 4, 5, and all of those fund series they've been performing well. Then that means okay, do it. These types of fund managers are the large cap, but they do everything globally, and they do on a sector agnostic base. So they do everything that is on an opportunity, right? So right now, what companies are benefiting most? The post-COVID life sciences, real estate, all of oncology. These are the companies that are doing well. So they put the money. But next month, if things change, hey, they will do something else. So you have the global sector agnostic, but you have the more left you go, you'll see smaller funds, mid cap. Requires more work. The companies that they are trying to acquire, they're much smaller in size. So for example, tech, you barely have 1 million of revenue. Hey, but you believe in the growth here, then you should do VC funds. Yeah. So it's a matter of the opportunities that you see in the market. Yeah. But again, retail investors today are still not. I mean, if I could own Grab pre-IPO, I would, as a retail investor, but I can't, right? So think about it once the opportunity set comes to you, and once ADDX, for example, has democratized it and has the ability to not only fund out the fund managers, but also, hey, be able to help retail investors access companies directly that are private through your platform. Yeah.
Thank you very much. And unfortunately, that's all the time that we have for today's Fireside Chat. So once again, thank you very much, Victor, for sharing this studio with us. And thank you very much to the ADDX team that made it possible. Do look out on our website, www.addx.co, for more information and for upcoming webinars. And until then, I hope to see you soon. Thank you. Goodbye.
Thank you.